And welcome. It's episode number 54 of the podcast, 54. A great number, by the way. Some of the best defensive players in NFL history wore number 54, perhaps none better than Randy White, legendary Dallas Cowboy turned BBQ pitmaster. And a little non-rental housing trivia for you. Randy and I share something in common, something very little, but we both graduated from the University of Maryland and then moved to Dallas. So the only real difference is he was a 9-time All-Pro Super Bowl champion and made the Hall of Fame. Just a few details. All right. So enough of that. Let's get into construction today. Is it time to build again? We're going to lay out the case for it today. We got the latest data on apartment supply, starts, and future completions. We'll also talk about an interesting wrinkle in today's market that could, and I hope this isn't hyperbole, but I think it could permanently shift the composition of apartment development. Specifically, I mean this: larger developers are taking a larger share of the starts. They're not doing more, but taking a larger share because smaller players that dominate most of the market in terms of starts are doing less. So is today's environment of high rates, high cost of capital, soft rents, is that making it harder for smaller developers to stay active? I mean, it honestly, it's hard for everyone, even for large developers. But I think it's especially hard for those groups who do, one or two projects a year, which is the majority of the market, and therefore don't have the efficiency of scale to squeeze enough juice out of the lemon to make deals pencil out in today's environment. Historically, something like 3/4 of all apartment starts come from small local developers. So are we at a moment like we saw the home builders go through during and after the great financial crisis, where bigger players gained market share, survival of the fittest? Well, I don't want to overstate this, of course, because there's always going to be exceptions. And some of you probably listening, you're probably doing some great things as smaller developers to stay active as well. There's going to be exceptions. There's very smart, very good, innovative smaller developers out there who may have access to steady sources of capital. But I think that's going to be more the exception than the rule. I think we'll see larger developers continue to gain market share. I'll show you some data on this in a moment. Not necessarily, again, a lot more projects, but a larger share of a smaller number of total apartment and build-to-rent starts. And this is going to tie in today's interview as well. We've got a special one today. It is our first ever interview on the Rent Roll in front of a live audience. And this was really cool. A lot of fun, a lot of energy at an event with JPI at the Hotel Drover in the Fort Worth Stockyards. I sat down with JPI's CEO, CIO/CFO, and the Chief of Construction and Design. And we talked about this topic, specifically what's JPI doing to drive efficiencies in an industry, construction, that has notoriously seen very little efficiency gains over the last few decades. I'm sure all of you have seen those stats and stories about how construction has been the one industry to see very little in terms of productivity and efficiency gains in recent decades. But now, what are we seeing? It's starting to change. So what are groups like JPI doing to drive efficiencies in construction, using new technologies to reduce the timelines, reduce waste, and therefore reduce costs, and make deals pencil out that might otherwise not pencil out in today's environment? So that's going to be fun. So stick with us for that conversation. And also just a really quick programming note. Next week, we'll be doing our Q3 apartment market update and outlook. Got the latest and greatest data available, and we'll give some thoughts on what it all means for that rebound that everyone is anxiously awaiting. All right, so let's before we get into it, let's give a shout out to our sponsors. First, a shout out to Madera Residential, a leading apartment owner and operator in Texas, expanding into the Southeast as well. Check them out, maderaresidential.com. And also, of course, to JPI. JPI was gracious enough to host and record the live taping of the interview this week at the Fort Worth Stockyards. And JPI is, of course, a leading developer with a stated purpose to transform building, enhance communities, and improve lives. All right, as always, we kick it off with, here's a chart, and we got a few of them for you. So we're going to talk about the case for construction. And just to keep it simple, we're not going to assume any kind of big rate cut. And let's not also assume a material change in construction costs. In fact, this is an interesting stat for you. The most recent NMHC survey of builders and developers just came out a couple of weeks ago. It shows less than 30% of builders and developers expect construction costs to rise in the next 3 to 6 months. It's less than 30%. And it's just about the same percent that expect costs to decrease. while the balance say costs should be unchanged. So it's pretty crazy given the narrative on tariffs and labor. And we'll dive into that topic more in today's interview. We're going to ask JPI's head of construction about that. And we've talked about this with other developers on this podcast as well. So if you're a longtime listener, you probably know where that one's going. But it's interesting because the story hasn't changed. And that gets us, okay, so it's not so much about maybe expect, well, let's assume that rates aren't materially changed. Maybe you get a couple more cuts, so it's not going to materially change the math. We're not going to materially change the math through construction costs. And that takes us to fundamentals, to NOI, to rents. And that's important because according to that same NMHC survey of NMHC survey of builders and developers, the number one reason by far, the number one reason for construction delays is project is not economically feasible. So if a project is not economically feasible, that means the developer doesn't think there's enough demand for apartments at the rent levels needed to justify the market cost. The market's not going to bear that. Even if people can afford it, they have other options that are comparable at a lower rent than what a new project needs to pencil out. 83% of developers said this was the number one hurdle to construction. Another 61% blamed, quote, economic uncertainty, which is, of course, a related problem. So here's an illustration of this issue. Let's look at effective rents for apartments built in this cycle since 2020, in the 2020s. The average rent for an apartment unit built in this decade is nationally is $2,236 as of September 2025. That's basically where it was 3 years ago. If you can see the chart on my screen, if those of you who are looking at the video version, you can see it's been a pretty straight line these last 3 years. And in a lot of markets, what this really means is that in a lot of markets, your average brand new lease up is commanding about the same rents as a brand new property did 3 years ago, back in 2022. And yet, we talked about construction costs earlier. Obviously, construction costs are up since 2022. So something being built today was likely more expensive than something built 3 years ago. And so that creates some tough math. So it's tough to build when rents haven't moved in 3 years, but costs have. So just to quickly recap, this is kind of an illustration of why this is so tough. A couple months ago when I covered the last round of REITs earnings calls, we touched on this topic. MAA, the largest REIT by unit count, they said development returns would have to improve 10 to 20% for more projects to be feasible for most merchant builders. Now, of course, MAA is not a merchant builder. They're a build to own, so they have different math. It's a little bit easier for them, lower cost of capital. But most developers are merchant builders with a higher cost of capital. And by the way, MAA is still building. And part of why they're building in Avalon Bay and Camden and others is because they see a favorable moment. They're building because they see how little is down the pike, and they have the scale, the capital to make deals work that might not work for your average merchant builder, particularly a smaller one. Now, of course, that's everyone's thesis, right? There's going to be less to complete in 26 and 27, maybe 28 as well. So it makes sense to deliver at a time when others can't. And REITs like those guys, they're putting their money where their mouth is. But why build instead of buy? And we'll talk about this in our interview today too, but I'll say it quickly because on paper, it may seem cheaper to buy than build. In reality, it's not that easy to do so, at least not on any scale for newer vintage, well-located apartments. That's the stuff everybody wants to buy, particularly institutional capital. That's what they want. So there's a lot of competition for that. Cap rates back in the 4s, as I'm sure everybody knows, and not a lot of product that even hits the market. So if you're going to deploy real capital into newer vintage, well-located apartments, it's going to be tough to buy your way into that unless you're buying a sizable portfolio of assets. And then all of a sudden, development might look better. So that gets us to a point I made in the opening, that this is an environment where it's just going to be tougher for smaller developers to compete. And by the way, I'm rooting for them. I like that we have a very broad, diverse market, but it's tough, and it's been tough. It's been tough. It was tough even last year for smaller developers to keep active. So here's some key context for you to illustrate how smaller developers play such a crucial role in apartment construction. Let me give you some numbers. Last year, in the U.S., we completed 2,801 market rate apartment projects across the country. Those 2,800 projects came from 1,536 different developers. That means most developers are doing one project a year, maybe one or two. And on that note, related stat, here's a good one from NMHC's top developers list, largest, most active developers. Traditionally, the top 25 developers, they start about 20 to 25% of all new multifamily units nationally. But last year, in 2024, the NMHC top 25 largest developers represented 32% of all U.S. apartment starts. And that was the highest on record, which goes back more than 10 years. And I think that share is going to grow further here in 2025 before it's all said and done. So again, that doesn't mean large developers are building more. Most are actually building less than they did at the peak, but their market share is up because most smaller developers are doing even less. A lot of them are sidelined. Okay, so what does this all translate to? Okay, starts are the lowest level since 2013, back when we were rebounding out of the GFC, but it does appear that starts have bottomed and likely are leveling off around 250,000 units per year on an annualized basis. So we've been around that mark for most of this year, around that 250 number. And that may sound like a decent total on the surface, but just for some comparison, again, it's the lowest since 2013, but also the peak in 2022 was 600,000. So we're less than half of that today. So in terms of completions, we had 586,000 last year. This year, we have an estimated 515,000 scheduled to complete. That's a big drop off from 2024, but 415 is still a lot. Aside from 2024, it's the biggest year since the mid 1980s. And we'll talk about this more next week on the Q3 update and outlook. But I think that's why a lot of folks got ahead of their skis a little bit when they're thinking 2025 would be a big supply slowdown. Yeah, it's down a lot, but the total number is still a lot. Plus, you have a lot of 2024 completions that are still working through lease up. So the real slowdown starts in 2026. We have about 300,000 scheduled to complete, and then we could see less than 250 in 2027, and maybe even 2028 at this point. Last thing before we move on, let's look at the supply slowdown by market. When do we get below, not the peak supply, but below pre-COVID normal supply levels? And so I looked at scheduled completions compared to what was the average prior to COVID. Well, we're already there in a bunch of spots. We're back below pre-COVID levels in a bunch of spots, and most of these are chronically low supply markets. But there are some other key spots in this group, like Houston, Seattle, West Palm Beach, Washington D.C., Kansas City, Chicago, as well as San Francisco and Orange County. And then by year end, Nashville is going to be in that group too, particularly suburban Nashville. Still a lot to go through downtown. Indianapolis will be in that camp as well. Then Dallas, after the calendar turns to 2026, in the beginning of the year, they're going to be at supply levels below pre-COVID average. And by the first half of 2026, we're going to see numbers drop below those marks in Austin, Salt Lake, Jacksonville, Denver, San Antonio, Orlando, Atlanta, and Boston as some examples. Then in the second half of the year, we'll get there in Raleigh and Charlotte, Columbus and Philly. And some are going to take longer than that, maybe 2027 before supply drops below pre-COVID norms. And that includes Phoenix, Fort Worth, Tampa, Richmond, Miami, Northern New Jersey, among others. And that's going to take us right into today's rental housing trivia. All right, so we're just talking about scheduled completions and how much is left versus the pre-pandemic norm. So that's going to be what today's question is about. Current construction is below pre-pandemic norms in most major MSAs, but there are some exceptions. So which MSA still tops its pre-COVID average by the highest margin in terms of total number of apartments under construction? Is it A, Austin, B, Columbus, C, Phoenix, D, Raleigh, or E, Tampa? So give that some thought and we will answer it in a moment. But first, in the news. All right, in the news, we cover some headlines touching on topics related to SFR and multifamily and other topics in rental housing and renters. So this first one, here's a good study to support apartment development, which of course is our topic today. Let me read from this. It says, it's from Pew Research and Pew Charitable Trust. It says, modern multifamily buildings provide the most fire protection. Rate of death is in most modern apartments is 1/6 the rate of single-family homes and in older apartment buildings. All right. So it says a large body of research has demonstrated that apartment buildings and other types of multifamily housing can provide many benefits to a community, especially when built in high demand areas where housing is badly needed. Multifamily housing can boost economic opportunity and foster growth while improving affordability by increasing the availability of housing near jobs, stores, and transportation. It can reduce commute times, traffic, energy consumption, and water usage. The United States is experiencing both a nationwide housing shortage and a record levels of homelessness. More multifamily housing can help address both problems. So there you go. Pretty good research. Pew's been putting out some good stuff of late on housing, and this is another good one. Next one comes from Bloomberg's City Lab division, and the headline is, with rental registries, cities seek to close the data gap with landlords. Cities like Pittsburgh, Oakland, and Rochester have passed ordinances to track property ownership and mandate inspections for rental housing, but landlords often resist. So you notice those cities, Pittsburgh, Oakland, and Rochester, they're not exactly institutional markets. They're heavily mom and pop. And that's going to be important as we dive into this, because let me read more thing from the article. It says, supporters of rental registries, including city officials and tenant groups, see them as a necessary tool to address critical information gaps and protect public health, with many U.S. cities having already enacted similar programs to proactively enforce housing codes and track landlord compliance. So I want you to think about this for a moment. How like a rental registry, I'm sure it sounds good, like a lot of ideas. But think about who this impacts the most. It's really not going to be institutional groups or even sub-institutional groups with, on-site property management teams and have, a company website and a property website. Those groups, they have contact information very easily accessible. A public registry is far more problematic for small mom and pop landlords who dominate some of the cities we just talked about because they're providing their personal contact info and address. Let me state the obvious. Obviously, having units in disrepair is good for no one, but contact info should be on a lease. And if the issue is unresolved and there's a code violation reported, it shouldn't be that hard to track them down. There's still public records on who owns these properties. All right, next headline comes from the Wall Street Journal. It says, rise of accidental landlords is bad news for investors who bet on rentals. Problems in the for-sale housing market are starting to infect the rental business. All right, so I've been talking about this for a while. Glad the Wall Street Journal, I think the New York Times picked on it. A bunch of groups, a bunch of media outlets picked up on this. So some report came out of batch data on this topic. And I'll tell you what, I'm glad to see we're finally starting to acknowledge that a weak home sale market does not equal a boom in the rental market, even SFR, okay? But also, as you're reading in this article, what's really interesting is that no one wants to just say it, but I'm going to go ahead and say it. It's what it's showing us that it's not institutional investors gobbling up homes off the MLS and keeping home prices high. It's more likely to be would-be individual sellers choosing to hold on to homes as a rental. So right now, it's a bad market to sell if you don't have to in most markets. If you do need to move, you have cash and the debt-to-income ratio to buy another house, it might make sense to hold on to your old home as an investment. And those, quote, accidental landlords are far less concerned about, yield on cost or operating margins as a sideline larger investor would be. And they're more concerned maybe with long-term value appreciation and just the perception that they're not selling at a good time. They want to wait. So, but that gets us to that point here is that individuals and families with 1 to 5 homes, they have 90% market share in SFR, according to our data from batch data that was reported by Resi Club last week. And then the institutional investors, they have according to batch data, they have wait for it, 1.6% of the market. And as you know, there's no other industry on the planet where there is so much angst about 1.6% market share. 1.6% does not move the market, okay? Anyway, the accidental landlord topic is an interesting one to watch. I'm sure a lot of them are going to find out that, quote, passive income isn't always so passive when it comes to owning and managing a single family rental. All right, let's jump over to Los Angeles. And this is the LA Times. It says almost no one is building new apartments in Los Angeles. Here's why. All right. Interesting story. We've been talking about this on the Rent Roll for, I think almost a year now. And obviously, I'm not the only one. It's not a secret. And so the REITs I'm talking about the earnings calls. I realize I said I'm giving myself too much credit. This is a widely known issue, right? So let me read some of this article. It says developers say they can't raise the money they need to build as many of their biggest backers, think pension funds, insurance companies, other institutions looking for long-term investments, don't want to park their money in LA because the rapidly changing rules make it impossible to predict profits. the years since COVID-19 have demonstrated how tangled regulation of the industry can get in LA. And so they're taking their money to other cities. And there's a quote from a developer who says, LA has been redlined by the majority of the investment community. And I've said it before, I'll say it again. It's great to see a growing movement supporting more development, making it easier to build. We've seen this in California with CEQA reform and some other things they're doing there. Those are all positives. But we can't just celebrate investors when they build housing and then demonize them once the construction completes and they start operating the housing. That does not work. If you can't execute a business plan, you can't build housing. And, right after this article came out, as if right on cue, there was another news article that came out about a rent strike in some properties owned by Equity Residential. And I read through the article, and guess where it starts? Where is it starting from? Los Angeles. And of course, ironically, we know Equity Residential, they operate Class A plus properties, catering to renters with very high incomes, not likely affordability issues there. But there's a group withholding rent trying to win some various building improvements. And hey, why not? Rent payment seems to be essentially optional in LA. And so stuff like that is why no one wants to invest, 9 figures to build new apartments in the city of Los Angeles. Now, other parts of SoCal, I think, still could be very solid. The city of LA and parts of the county of LA, they don't seem to really want to build housing. Anyway, hopefully LA finds its way and with some common sense reforms, but I'm not holding my breath. All right, speaking of reforms, here's an article from Biz Now in Washington, D.C. It's our last headline of the week. It says, D.C. housing industry awaits swell of investment with TOPA reform. So TOPA reform, I've talked about this a few times, most recently related to the Avalon Bay sale of, I believe it was 4 properties in the District of Columbia. And TOPA gives the residents of the property a first right of refusal to purchase it. So you get a binding offer from a potential buyer. Now you got to give the residents a chance to raise $100 million plus as if they have any chance to do so. But in reality, it ends up being a stall tactic. And so there's been a lot of push to reform that. And so this article is anticipating that reform now that DC has passed this reform. But is it nearly enough to bring a swell of investment into DC apartments? I know my friends in DC are hoping that's the case, and maybe they're right, maybe I'm wrong, but I think this reform was really watered down by the city council. Okay, so the big reform, if you want to call it that, is a 15-year exemption for new construction. But here's the problem with that. Investors can read a calendar. So the thing to remember is that every buyer needs an exit plan. So a 15-year exemption, that's going to help the merchant builder building the property, but it doesn't really help their buyer because the first buyer may be fine with a 15-year window, but when it's time to sell, the next buyer may find that problematic because now they're likely inheriting that risk. And there have been some real horror stories of long delays, deals essentially held hostage through TOPA rules. And again, in most cases, the residents have no chance of buying the property, but they're using it as leverage to gain concessions on rents or amenities or building upgrades from the next buyer. And that could take months and months and months and delay a deal. And that's very complicated. I mean, that's a significant challenge for investors. You want to have some certainty around the close. So we'll see. But I just have a hard time seeing how a 15-year exemption could invite a, quote, swell, unquote, of investment. Probably some. I'm sure some will. But a swell, I think that's a stretch. All right, let's get back to this week's rental housing trivia question. The question was, current construction is below pre-pandemic norms in most major MSAs, but there are some exceptions. Which MSA still tops its pre-COVID average by the highest margin? And I gave you 5 choices: Austin, Columbus, Phoenix, Raleigh, or Tampa. And the answer is Phoenix. Construction in Phoenix at the end of Q3 was still 12,000 units above its pre-COVID average, as measured by the average construction total between 2017 and 2019. So that's a big margin. Now, I guess in fairness to Phoenix, Phoenix didn't build a ton prior to COVID, so that helped spur the big initial boom we saw in rents in the early COVID recovery period, and then construction really ramped up after that, and rents tapered back quickly. So still a ton to work through today. more than 27,000 units in total under construction, and it's especially concentrated in some of the western submarkets, places like Goodyear and Avondale, et cetera. All right, next up, it's time for today's interview, sponsored by Funnel, the AI and CRM software trusted by 4 of the 6 major REITs and many more leading operators like BH and Cortland. To learn how Funnel can help your property centralize operations and automate everyday tasks, visit funnelleasing.com. Okay, so today we have a special treat. I mentioned this earlier, at least special to me anyway. Hopefully it is to you as well. It's our first podcast recording in front of a live audience. We had the opportunity to record a group interview with JPI's leadership team, CEO Payton Mayes, CFO/CIO Mollie Fadule, and Chief Construction Design Officer Kyley Harvey. And we just recorded this event. This interview, I should say, at an event at the Hotel Drover in Fort Worth, inside their barn hall, which is quite the venue if you've not seen it, right at the Fort Worth Stockyards. Strong Texas feel to it. It's funny. People always come to Texas event, been here, and they see Dallas like this looks nothing like what I expected, like Dallas the TV show for those who are of that generation. And you get to the Fort Worth Stockyards, and that's kind of what you were expecting. And this is a really nice hotel that maintains that Texas traditional feel. So, anyway, usually these interviews are online or in a tiny little studio by ourselves. So having a live audience, that was a treat. Lots of energy in the room. So big thank you to everyone who participated and to the JPI team for inviting me to record there at the investor event. Had a lot of fun doing this live, and something I hope we can replicate in the future at other venues. So anyway, we're going to talk to Payton, Mollie, and Kyley about JPI's strategy, the case for new construction, expansion into new markets, and also about a big push to use technology and innovation to drive efficiencies needed to get deals to pencil out. And I'm sure other large developers may be able to drive efficiencies of scale too, but when you hear some of the things that JPI is talking about, and again, I'm sure there's always exceptions, there's always going to be exceptions, but I was really left with, and I usually think about this as well, is if 75% of starts come from small developers doing 1 or 2 projects a year, how can those smaller groups keep up with that the type of things that you're going to hear about today? And by the way, I hope they do. I'm not rooting against you for those of you there, but I think it's going to be tough. So we got to find more ways to keep it going. So we'll see. Anyway, without further ado, let's jump in. Here we go to the Fort Worth Stockyards for today's interview. All right, so ladies and gentlemen, we have the first ever live podcast of the Rent Bowl. So thank you so much for being here. Yeah. All right, we are in the beautiful Hotel Drover in Fort Worth, Texas, and we are talking about construction trends. And Payton, before we get into some of the details, JPI, we had an ownership change. 2 years ago now?
It will be 2 years in November 30th.
Yes, I'm curious to ask. I'm sure you get asked this a lot. How has the strategy, or maybe just the ability to execute, changed since the change of ownership?
Yeah, so I would say the strategy really hasn't changed. Just some background. A lot of the folks know this, but JPI, we had our 36th birthday this July. So JPI's got a long-term track record, have been in the business a long time. After the GFC, with limited working capital, the company made a strategic decision to really focus their efforts in Texas and Southern California. So, deeper and fewer markets. And that strategy, I think, has paid off. In Dallas-Fort Worth, we've been the largest developer since 2016. Usually bigger than 2, 3, and 4 combined. And so, what that means, for us is, our prototype. We look at the land chase team looks at roughly 650 land sites. And at the end of the day, when we funnel them down, we try to start the best 10 projects. So that's been JPI's strategy, again, developer and GC. When we did the deal with Sumitomo Forestry, who we were very fortunate to have a relationship with, I met them back in 2014. They started investing with us at the project level in 2019, so we could get to know each other better and just see how we work together. And when we decided to, when the previous owners decided that they wanted to, they wanted to make sure that JPI lived well past their lifetime, and Sumitomo Forestry was an amazing partner. They were founded I say, more than 330 years ago. So it's hard to think about that. The U.S. will celebrate our 250th birthday next summer. Sumitomo Forestry was 80 years old at that. And so it's hard to fathom. So they think in the terms of decades and not quarters. And it's been, especially in this environment where it's been, capital markets environment's been a little bit more choppy. It's been we're very, very blessed to have a partner that thinks long term. We're not building, we're looking at 10 years out, not 12 months out. And so, grateful to have them. One of the things that, I think from a strategy perspective, they have been very, very supportive of the changes that we made on the leadership team. That I know Mollie and Kyley, will talk more about. But yeah, just grateful to have them, and our business is built to scale. And I know we'll talk more about that later.
So Payton, one of the questions I know you get asked a lot, question I get asked a lot at different events that I go to, it's the $100 million question, which is, it seems like maybe now it's cheaper to buy something and build something. And so why should I want to build? And so when you get asked that, and of course I have my own thoughts about it, but you're at the front lines of this. Like, why does it make sense to build now?
Yeah. It's a great question. We do get that question a lot. And I think, there's certainly, opportunities in the market today to, quote unquote, buy below replacement cost. But there's been a lot of capital, raised for that. And you've seen very few transactions actually transact. And I think why is that? Most sellers, if they have a capital structure that will allow them to, hang on, most of them are choosing to hang on because they, feel like that now's not a great time to sell if you don't really need to. And there's always, reasons that could be, unrelated that people are transacting. But even when you do that, there's, you'll hire a great broker and they'll do a nice package and send it out. But there's only one buyer that gets at the end of the day. There's a lot of capital below that that's not, that's number 2, 3, 4, 5 in the bidding, that's not getting anything. And so if people want to be invested in multifamily, there's not a lot of stuff that's actually selling. We also think really long term. And so, now there's obviously we're at a moment in time where supply has been greater than, we're at kind of historic high of supply. You talk about this a lot, Jay. Supply is one of the easiest things to forecast because, we know what's going to happen in 18 to 24 months. And so supply is definitely coming down. If we can put a shovel in the ground today on a project, then we know that it will be delivering at a time when there's less competition. And we're still, the U.S. is still structurally, we have a shortage of housing in the markets that people want to live. So say that. The other thing is we've spent a lot of time over the past, several years working on, expanding our, developments to some more affordable workforce housing. And that include public-private partnerships with municipalities. And those municipalities, they want quality new housing. There's a lot of what we talk about convergence, taking stuff off the tax rolls and making it, affordable. What they like to do is add new housing, which we know, I've heard you say this a lot, which something certainly agree with. New supply is the only thing that's going to solve our affordable housing issue. So that's another thing is a lot of our, pipeline has some sort of public-private partnership to it.
Yeah, absolutely. I think, one thing I think is important in this conversation is that I think new construction is a win-win for communities and for investors when we do it. And I'll add one other thing, Payton, is that I've seen a lot of groups, you have as well, these last few years have raised a lot of capital for distress acquisitions, thinking I'm going to get all these great, new construction and great locations, these great discounts below replacement costs. And a lot of that capital has not been able to deploy because what they're finding is a mismatch of opportunities where, first of all, if you want newer construction, it's going to be in a market that a lot of capitalists want to be in for some important reasons, like Los Angeles, because the issues going on related to regulatory risk in a market like that. Or if you're here in Texas, it's probably going to be, 30, 40-year-old apartment properties in some markets, neighborhoods that institutional capital really doesn't want to be in. So I think in terms of one thing I think we're becoming clearer and clearer is if you really want to get in some kind of scale in newer construction, desirable locations, kind of have to build.
And I think, it's one thing I think sometimes multifamily has a, bad name, and, I've been to, even folks in my hometown, or not my hometown, the place where I live in today, it's anti-multifamily.
Yeah.
And, I talked to them. I was like, when's the last time that you've actually gone and visited a quality new Class A multifamily, development? And a lot of times it's never. I mean, we walk into some of these places today and it's like the Four Seasons Hotel. My son, we live in a pretty nice house. And my son says, we were visiting a project out in California not too long ago. And he's like, Dad, I want to move to that project. And so, I think it's a good point. It's the quality of housing that's built today is much, much, much different than what it was 20 or 30 years ago.
Yeah, no, I joke all the time. I tell people, like, when I graduated college 20 something years ago, I wanted to move out of my apartment the day after I moved in. Because in that era, like, they're kind of generic, sort of, just the thin walls, everything else. And now it's like, these are really nice places and good locations, and they're better kind of overall experiences for everybody. And to your point, I wish more of our policymakers and some of the homeowners who oppose multifamily would actually come visit.
Yeah. So if people are out, listening to the podcast, we would love to have you visit one of our communities at JPI.
Absolutely. And I also want to say too, I mentioned Los Angeles. It's the city of Los Angeles is notoriously challenging. Obviously, you're seeing better environments in other parts of Southern California where JPI is active. Yeah. Speaking of parts of the country, JPI, you mentioned this, obviously have significant advantages of scale in Texas and in Southern California. How do you, or can you, take those advantages of scale and we'll talk to Mollie more about kind of how we look for new markets, but can you take those advantages of scale into these new markets that as JPI grows geographically?
Yeah, I think one thing to note is as we have expanded into some additional markets outside Texas and Southern California, JPI is re-entering these markets, right? JPI, again, I mentioned 36 years. I think we've developed 120,000 units. We're all by the end of the year, Lord willing, we'll be at 400 communities that we've put a shovel in the ground on. So JPI has been in a lot of these markets before. It's interesting. I'll go to a conference and have the Payton Mayes JPI, and it's the JPI alumni network out there is huge. And so one of the first things is how do we do it? Well, we hire amazing talent. And you're a great example, Jay, of we were so fortunate and blessed to get someone like you that chose to spend some of your time with JPI. I always like to talk about I'd be remiss if I didn't talk about Scott Turner as well. Scott had a number of different opportunities to spend his time, and Scott, for those of you who don't know, is our new Secretary of Housing and Urban Development. And Scott chose to spend his time at JPI before he did that. We've got some amazing talent on the team, and I think folks in these markets that we're re-entering are super excited about joining JPI just because of the I think the name, the track record. But when they hear about some of the things that Kyley and the construction team are working on, they're even more excited. And so that's one thing. Starts with hiring great talent. We've also got amazing talent that's been with JPI for a while. That's helped us build this operating system and playbook that we can redeploy that talent and team them up with folks in these other markets. And then also some of the what we're doing that, again, Kyley will talk about of centralizing a lot of the oversight and planning, et cetera. We don't have to be in some of these markets. We can pair that up. In a lot of other industries, we've kind of taken some playbooks from other industries that again will help us plan and do better. So materials, that's a great example of something that we can get when we're buying doors or hardware. We can do that. We can get bulk savings, not just in Texas. It doesn't matter where you are.
Well, speaking of leadership, the one person you didn't mention is somebody who used to be a CEO at a international, Fortune 500 international company.
Yeah, I think it's Fortune 50. So yeah, Paul Kipsgaard, is an amazing talent. And, I thank the Lord every day, but not often enough that he's with us partnering at JPI because, Paul it's public information. You can look it up. Paul is making, $20 million a year, plus at Schlumberger. And, I remember having the conversation with Paul. I said, Paul, that's going to kind of bust our budget. We don't have we don't have that. Paul's like 19 million will do. And but all that to say is that Paul, again, amazing world-class talent. There's very few people that have sat across the room from Putin and negotiated deals, and just he's an operational genius. You've spent time with him, Jay. You know this, and the perspective that he brings to the business about looking at it through a different lens has been super, super helpful. And again, I think if we're attracting talent, I think my number one job is to attract, grow, and retain the best talent. And I think if folks can, we've got some amazing people that have decided to join us, and it's a lot easier to attract great talent when you have great talent on the team.
Yeah, one of these things I want to get him on the podcast. I want to ask him: is it easier to negotiate with Putin or the mayor of some city that said a gold apartment? They're going to fight all this traffic and crime, more kids in their schools.
Yeah, I'm sure he'll have a perspective.
Yeah, I'm very curious. And by the way, I also want to give you mentioned Scott Turner. For those of you who don't know, it's good trivia you take home with you. Scott is the very first ever Secretary of Housing and Urban Development who actually has an experience in the private sector building housing, thanks to his role at JPI.
Yeah.
I think that's really significant to have that background.
Yeah.
All right, Mollie, let's turn to yours. Chief Investment Officer, Chief Financial Officer. One of the things you and I had a conversation last week, I thought I wanted to bring here to this format. We're in I think a bit of a changing environment where historically something like 75-80% of apartment development comes from small local builders, maybe do 1-2 projects at most in their given markets in a year. Those groups are particularly challenged right now to get the efficiencies of scale we'll talk to Kyley about, and certainly higher cost of capital. And we're seeing a lot of them are just completely sidelined. And so I'm curious to ask you, do you think am I right? Are we in a pivotal moment where we're more dependent on companies like JPI to build? And is it going to look kind of like what we saw coming out of the great financial crisis, where on the single family side, we saw the larger home builders became bigger and a lot of smaller groups kind of disappeared?
Yeah, we absolutely see that trend happening now, and similar to what we saw right after the GFC with consolidation among the top home builders. About the top 10 single-family home builders build about 70% of the supply, and as you mentioned, about 75 to 80% of the multifamily starts are small developers doing 1, 2, 3 deals a year. So the top 10 multifamily builders really only account for between 10 and 15% of market share. And so it's our view that in this capital markets environment in particular, there is an advantage to scale, particularly with an integrated business like JPI's, where we do have design that we've brought in-house. We are an integrated GC, and we've further integrated, which Kyley can talk about on some of the trades side of the business. And we believe that that's giving us an advantage in a more difficult capital markets environment to be able to, find ways to still get projects built when, return requirements, remain the same and capital continues to be expensive. It's also difficult in today's environment when lending standards have gotten much more strict than they were in the lower interest rate environment period to have banks supporting, some of those smaller groups. And so we do think that's also an advantage with scale to have those capital relationships that are still continuing to lend to or invest with folks that, have large scale business and are able to find competitive advantages through that. So we do think that that is a trend that will continue. And as we look forward towards the next 5 and 10 years in the markets that we're targeting, we're really looking to be that large market share provider in the markets that we go in. We look at data on a regular basis, and part of the data that we look at is, if we're taking, 10 or 15% market share, what does that mean? Who are the other developers in a market? How do we look at that opportunity? Because if we are going into a market, we think it's important to have that size and scale to have a sustained competitive advantage.
Yeah, that's a great point. And I think for those who are in the multifamily investment space, I think it's really important to understand that just because you see groups like JPI still able to build and start new projects, it doesn't mean there's the market's like just storming back. The floodgates are not reopening because, again, 3/4 of the market are smaller groups that, most of them have a hard time doing much at all unless it's, a tax subsidized project and something like that. So it's groups like JPI, I think, play a very important role in providing an essential good, which is housing, right? So let me, speaking of development, one of the things that, if those of you don't know, multifamily is still, as you know, the preferred asset class in commercial real estate. It's the number one in terms of sales dollars invested in commercial real estate in the U.S. Earlier this year, I saw a survey from international investors, and they identified, it was in some ways assuring because of all the, we all see headlines, we feel the craziness of being, in the U.S. on a daily basis, everything that goes on, but international investors still see the U.S. as the safest place to place capital. And then this survey from a group called AFIRE, International, I forget the acronym, it's International Real Estate Investment Group, Association. Their number one real estate class that they want to invest in within the U.S. is multifamily. And we've seen this in the surveys of domestic investors as well, that very bullish on a lot of, there's recently a survey from CRE Daily and John Burns showing that the majority of them want to increase their allocations to multifamily. And so, Mollie, my question to you is, as you're talking to different groups, institutional investors, large family offices, individual investors, there's obviously appetite for multifamily, but what trends are you seeing in terms of what's changing? How is it shifting from the prior cycle in terms of what they're looking to do?
Yeah, I think we're definitely feeling like there is backlog in terms of investment dollars on the sideline looking to get into multifamily. As Payton mentioned, there's a lot of folks looking to buy below replacement cost, but yet not a lot of volume of transactions taking place. And, it is very difficult today to attract capital to multifamily development, but there's a lot of folks out there that have money for multifamily development. And I think what we're seeing in terms of some of the trends is that we're hearing groups that are saying, we want to go direct to sponsor. So larger family offices, institutional investors that are not necessarily set up to invest direct, are starting to look more going to, rather than aggregators of capital or funds that are more diversified, saying, hey, how do I find, the top multifamily developer, industrial, whatever it is, and partner with them for programmatic, investment of capital. And so that is something that we're seeing and we think will benefit from. We're also seeing a lot of these large groups that have so much capital that looking at one deal isn't interesting. And so, they're talking to us about, hey, we want to be able to deploy multi-millions of dollars of capital rather than looking at, one deal and investing, really setting up a program where you're looking at 3, 5 or more transactions at a time. And so that's also a trend that we've been seeing. That doesn't mean that it's easy to get 3 deals capitalized at once. Let me be very clear. It is very hard to capitalize multifamily development deals today, which is one of the reasons why we think it's a great time to invest. But those are a couple of the trends that we're seeing. And I think as rates do come down, we're already starting to feel a little bit of thawing in the market and more interest in development, particularly as that cash that you've been talking about that's been set aside for allocation to multifamily hasn't been deployed into acquisitions.
Yeah. And on that note, I'll tell you, early on in my career, one of the things I was really struck by is how larger institutional groups, they like to write big checks. And so the opportunity to work with, one group, and they see that as a much more efficient use of capital than, cutting a bunch of small checks. And so, to your point, being able to have more programmatic relationships seems to be another reason why we're probably going to see larger developers take a larger share of, future development, and why JPI is well positioned. So, Mollie, part of future development plan for JPI is obviously expansion into new markets. And I had the privilege of working with you a little bit on this project, but talk to us a little bit about what goes into the process of identifying where JPI wants to be and then prioritizing, where to start building first.
Yeah, absolutely. So thanks to your help on the data side and pulling together a number of different data sources, we've used about 40 pieces of data and information. Some's public and some's private, through a scoring system where we take the top 50 MSAs, run that through a model with updated forecasts. We'll look 10 years forward in terms of some indicators and weigh different demographic data, income, information, education levels, regulatory or developer friendliness type, rankings. And then it spits out a ranking of top, really we focus on 20 MSAs throughout the country that we think are attractive for multifamily investment and meet the criteria where we can be a large market share builder in the markets, which means we want to be doing, 3, 4, or up to, in Dallas, we're doing about 10 projects a year. And so that data is refreshed on a semi-annual basis. Most of the cities that have been in the top 20 are pretty much still there. There's been a couple shifts and changes as some new supply or some, rent control may be on the ballot. And we take a pretty rigorous approach to looking at that data and information. We're constantly trying to improve it, but that's how we set the model. And then once we have those cities that we want to be in, we look at who the competitors are, what type of market share they have. Then we get into the sub-market level data. And, as Payton mentioned, we've centralized a lot of our functions, and the kind of JPI playbook is something that we've documented at a very detailed and granular level. And we use that to expand into markets. So over the last few years, we have expanded into the Seattle market, Phoenix, North Carolina. From there, we're covering Nashville, and we're also expanding into Florida.
Yeah, and I appreciate that, Shab. We also probably give some credit to Connor to give a lot of the real layers. Yeah, so nice job, Connor. And so are any projects underway yet in any of these expansion markets?
Yep, we did break ground on a project in Redmond, right by the Microsoft campus in King County, which is Seattle, in May of this year. We're excited to get that out of the ground, and then we also have sites under control in all of those other markets I mentioned outside of Florida, which we're just in the early stages of entering.
Yeah, that's great. And, Seattle's a good example of, that's such a good submarket. There's been some challenges in the city, but obviously in terms of regulatory risk, but Seattle always strikes me as odd. It's like, it's a city that wants to go to war with its major employers, which I don't fully understand the logic of that. But, Redmond's a very, very strong submarket. And I think too, just so you all know, what I think is important about any time you look at markets is you want to be where people want to be and where capital wants to be. And those, I think, are two variables where you really have to place outsized importance as a developer, is because number one, you want to make sure there's demand for it. Number two, or from the renters. And number two, that, there's investor demand for those as well. And I think that's really what that top 20 list is they're markets that are highly liquid, but also markets that are going to be in high demand over the next couple of cycles.
Yeah, absolutely. And we want to be building up and down the income spectrum in all the markets that we're in. So we have a number of different ways in which we can structure and finance transactions. So, it's great to be able to go into a market like that where affordable housing is such a challenge and try to find a structure to be able to deliver more of that.
Oh, that's a good point. So it's not, so maybe you could expand that if you don't mind. So it's, as JPAS going to these new markets, you're still looking to do workforce, affordable, and Class A.
Yeah,
and all these
absolutely.
spots. Yeah. Is that obviously in Texas we have our own unique structures, and is that somewhat of a challenge, just getting each state having its own kind of structure for how these things work?
Yeah, it can be. The public-private partnerships are more prolific in some markets and not as much in others. But there absolutely is opportunity across all the markets that we're in to build up and down the income spectrum. It's just the structure of it changes.
Yeah, that's great. All right, so Kyley, let's shift over to you, our Chief Construction and Design Officer. And you've been really busy, and this is part of what really impressed me about what JPI is doing is some of the innovations. As I kind of joked earlier, is I think everybody knows that there's been so little innovation and efficiency gains in the construction business, not just multifamily, but all types of construction. We've seen a lot of increased use of technology and innovation across a lot of other industries, but not so much in construction until recently. So I want to get into that. We've talked a little about the efficiencies of scale. Let's dive into the details. It's tough environment to build. So for projects to work, I know you're really challenged to find ways to either cut costs or reduce the timelines for these projects to be more likely to pencil out. So how are you doing that?
Sure. Well, I'd go back and just say it's worth repeating what you just stated, in that we work in an industry that has not evolved nearly as rapidly or proficiently as many other market segments. Anything in manufacturing, they've gained productivity. They've lowered their cost over the years. Construction has absolutely remained stagnant.
Yeah.
Siloed, fragmented, you name it, low barrier to entry. All the hallmark problems are there of that stagnated industry. At JPI, we are looking to other industries. We're looking to Henry Ford, to Toyota. And we want to do for construction what they did for the automobile manufacturing business. I don't think you can look inwardly and solve that problem. If you want different results, you have to do things a little differently. As you guys mentioned, we have the great fortune of having Paul Kipsgard with us, who brings a wealth of experience from the oil field. They went through a similar transformation 30 years ago. And so we've gleaned a lot of that knowledge into what we do every day. I think that from centrally running support services out to our field teams, to taking on a real manufacturing mindset. We know we don't have a thing that moves down an assembly line, but we have people who can move around the thing. All of those lean thoughts and principles that went to make manufacturing what it is today can be applied to construction, and we worked really hard to do that. Another thing that the oil field has taught us is the fragmentation can be solved. We have integrated some of the trades businesses into what we do every day. That allows us to dictate pace, allows us to ensure quality, and allows a better product to be returned to our investors and our tenants. On our very first fully supported deal, we're already seeing the results. We are about 30% faster to first units in that very first deal. So, our systems are built for improvement, and so we expect we'll get better and better every time we start a new project.
30% faster. So, and time is money, right? So that's got to be really impactful. What about technology? We've talked about, there's not been a lot of innovation, but I'm sure some of you have probably seen on YouTube now some of the really cool technology around construction and robots and whatnot. Talk to us about what kind of new technologies JPI is using, what benefits you're seeing from that.
Sure. So technology for us starts at the very beginning. My favorite saying in our business is we don't have a finishing problem, we have a starting problem. And so for us, it all starts with a model. Lots of people talk about their utilization of BIM or trade name Revit, and the fact that they model. And lots of people do, but they don't use those models to construct. They don't mine data from them. They just use them simply to deliver 2D versions of what they've been drawing for the last 50 years. We take a little different approach. We build our models to be used in the field. So the level of accuracy and the serviceability of that thing as a construction tool are important to us. With that, you'll see guys on our sites wearing augmented reality glasses, swiping at the air, looking at the model overlaid onto the site, looking at a structure that will be there, or looking at a piece that's missing and what it's supposed to play out like. We have a little robot that looks like a Roomba that runs around printing lines on the slab. They're trying out right now one that looks like a dog, although it does have wheels on the feet. That's not very fortunate, but it's used for quality control and checking things, checking the accuracy against the model. And so all of these tools offer us the ability to put work in place to catch any errors early and to avoid rework. And for us, as you said earlier, the time is money. When we can avoid rework, it saves the project and saves our investors and all involved.
Yeah. So, I imagine that's going to be a really big deal because, can you give us an example? Like if something, if someone's drawing a line for where some plumbing needs to go and it's off and you realize that later, like how many kind of domino effect problems does that cause downstream?
Yeah. A plumbing line is a great example, because it could be buried under a slab. A slab could get poured it could run up a building, and you could have significant problems. You could have to break out the slab and start over again. Or, God forbid you build your slab into an easement, which has happened, not to us, but to others, where, I know of a project here in Fort Worth that was built in an easement. And so, again, the avoidance of rework could be days, weeks, and, seven figures of cost to resolve.
Yeah, that's wild. So definitely, it's just amazing. I mean, you're talking robots, dogs, drones, the helmet camera things I think are really interesting. The project the what is it, the goggles that you can see the plans versus what's actually there. Am I saying that right?
Right. So, we actually have two versions of that. Virtual reality, which we use on the front end before we ever start to build, that allows us to coordinate the various portions of the model. And then augmented reality, which happens once we're in the field, and those are the guys you see with the glasses, viewing the pieces and parts of the model superimposed over the site.
Yeah, that's amazing. So yeah, it's just the old hard hat is much more. There's much more going on now.
Yeah,
there used to be. Yeah. All right, so Kyley, we can't talk about construction these days without talking about tariffs and immigration policy.
Right.
That's one of the biggest questions that gets talked about at industry events and conferences, investors, media. Everybody wants to know, and so I'm curious to ask you how are those policies impacting JPI?
Sure, I would say that is the single most asked question I get in the recent past. Look, I think that around COVID, we saw lots of supply chain issues that really pushed the industry to localize supply chain. And so for us, there are really actually very few things that come to us from overseas. Appliances do, although they're appliances made in the U.S. There are some trinkets within electrical systems and mechanical systems that certainly do. To this point, we have had really there's really been no impact on our projects related to tariffs. I think that the green building codes also have assisted with that over time because they value locally sourced material. So our supply chains have shifted from afar to near. And that's really helped us out in this case. On the immigration front,
let me pause there for a minute. So I think that's important for people to understand is like a lot of these changes. I mean, first of all, we had tariff issues in 2018, I think. Yes. And so in many ways, you and I'm sure some other builders out there, because some of the big home builders are saying the same thing. And I think a lot of the public and a lot of investors aren't fully aware. Like this is a kind of a theme. At least maybe it's for those with scale. You were in some ways prepared for this because it's not like the tariff conversation was new, right?
That's absolutely true. We've all been through it before. I think that I'll give one example that is sort of a copycat tariff. The first round of this, one appliance company I will not name, went to the government and lobbied for a tariff against appliances because they were left out. The government accepted it and said, yeah, you make them locally, we'll put the tariff in place. Well, the next day they raised their prices just equally with the tariffs. And so I think there's always risk, right, of cost increase. If you drive the commodity cost up, we could see fluctuation. But all in all, it's just no single component's that large of a piece, of the overall to have a tremendous impact.
Especially if you use American lumber, right? That's
absolutely,
a big piece of it.
Which we do.
Yeah.
Yes.
All right, so sorry I interrupted you. Immigration policy and
sure.
labor, and obviously, that's a big issue as well.
Sure, just like the tariffs, we've been through this before, probably a little before 2018 in this case. At this point, none of our jobs have been affected, and we haven't had similar the last time we experienced it, I think it was maybe a little more invasive than it has been this time. And we've not really had any impacts to our projects.
Yeah. Is it, does it help too that there's, at least among your competitors, smaller builders, there's just fewer jobs starting right now? That
is absolutely true. I would say that it certainly seems like in the construction side of the business, some point 9 months to a year ago, the spigot just shut off. And, there's a burn off in our business where, a job starts, takes a couple of years to finish it, right? And so we have, over the last 8 months or so, seen the quantity of bidders increase on our bid lists, and hear the murmurs in the marketplace, that the volumes are reducing.
Yeah. Well, Kyley, Mollie, Payton, thank you so much for letting me take the rent roll on the road here, and thanks for being part of this discussion. It's been fun.
Thank you.
Thanks, Jay.
All right, and thank you all for being part of it.
All right. Well, that was fun. Big thank you to JPI for hosting the Rent Roll Live this week. Thank you also to Madera Residential and to Funnel for supporting this podcast as well. And thank you to all of you for spending part of your day with us. We'll see you next time.